Hello and welcome back to another episode. My name is Jordan, I'm the Millennial Investor, and today we are going to be going over the dividend growth investing portfolio. I mentioned in my last video, if you didn't catch it, I talked about how I would be back, my plans for the channel moving forward, and I also talked about how in this next episode I would be going over the portfolio with all the dividend growth stocks as well as the 4 growth stocks that I own, and this is what this video is going to be about. And if you want to see the growth stocks, go ahead and fast forward to the end and we'll go over those 4. But we're going to do the dividend growth stocks, which many of you are here for, and that's what we're going to start with. And as always, we're going to show everything for the month where I'm at, and we're going to go over all this fun stuff, so it's going to be a great one. So stay tuned, and we're going to go over all these holdings, all 25 stocks that is in both of these portfolios, and I'm going to give you my quick little recommendation and summary of them and why I think they're good investments in my opinion. Do your own research. It's not financial advice, but this is my opinion for why I think they're great companies. If you haven't checked it out already, I have a mentoring session opportunity. If you want to reach out for a 1-hour session, it's $50. I can help get you started with your portfolio, troubleshoot M1 Finance, give you my tips and tricks that I've learned through investing. Not financial advice, but you can do that if you're interested, as well as get signed up for M1 Finance and get up to $50 for getting started there, and lots of other opportunities down below, including credit cards, savings accounts, and other things such as that. But go ahead and go to this first little sheet here. You can see that this is my month over month since I started investing. We've had some really good months. We've had some really bad months since I started my YouTube channel back in April of 2020, which is crazy to think that that was over 2 years ago, almost 2.5 years ago. And so far right now in my portfolio, this is my real profit and loss chart, unrealized of course, I haven't sold them. And this is in order, my largest to smallest investments: Amazon, CRM, iRobot, Chewy, and this is my performance since moving everything to my Fidelity portfolio at 34.65% for the month, 11.41 3-month, and then year to date we are trailing the indexes at negative 21.69%, and then there's my all-time performance chart right there. Now jumping over, if you haven't been familiarized with both of these, you have 2 different portfolios here. The first one that we're going over is the dividend growth portfolio, and this is for stability. This is for a defensive portfolio, and it's intentionally designed to be very, very stable, which is why a portfolio like such as this one is up 3%. Meanwhile, the market is down well into the double digits in the negative. Currently, the S&P 500 at the end of July finished at negative 12.58, and this one is actually in the positive by a few percent. And then we have the growth stocks, which are very, very offensive, not defensive. And when times are bad, they're going to underperform by a massive amount. And when times are good, they're going to massively outperform, which is why you see this outperformance here in the 1 month going up almost 35%. Meanwhile, the index is barely breaking 10%. So starting with the dividend growth portfolio, we have the largest holdings. This is in order from largest to smallest. We have W.P. Carey. This is a real estate investment trust that has an amazing track record, and they have been raising that dividend every single quarter for years and years on end. This company has still not recovered from its pre-pandemic highs of about $92, $93 a share, and it's currently trading at $85, and lately it has been on a bit of an uptrend and it's starting to recover pretty decently. But this is a REIT, a real estate investment trust, that is very diversified from both the Americas and as well as some properties in Europe, and it's in many different industries and many different categories, and it's very defensive because one, it already has inflation adjusted contracts, so it will go up, their rent will go up, I should say, as CPI goes up, and this is the reason why they pay such high dividend yield, because they're still very profitable and they put up great numbers. But even with this recovery, the stock is still relatively cheap. Compared to many other real estate investment trusts, it's not very expensive, and it's only a $16 billion company that is pulling in billions of dollars in profit. Their AFFO, or adjusted funds from operation, has continually been growing, and it's a company that I love, and that's why we have it as the top position, tied with these other 2, which are Lockheed Martin, our next one, which currently has a dividend yield of about 2.5%. Now, I loaded up on this one right at the beginning of the year, right around, I would say, January, maybe even a little before, maybe November, December of last year, which luckily for us, right before the Ukraine-Russia war happened, it had that massive spike up, and it's kind of fluttered around since then, kind of in no man's land. It's went up a little bit, went down a little bit, started to recover a little bit right here, but right now it trades at about 430, and this company has a massive track record for big dividend growth. from the 180s to $2 to 220 to 240 to 260, now at 280, and I'm assuming it'll be $3 plus on its next dividend raise, which, let's see, should be due in November, late November of this year, so just 3 months from now. It's a great company with massive backlog of orders from the United States government, and they provide most of the products for United States Air Force, and they are extremely profitable in doing so. So whether it's missile systems or submarines or different type of technology panels and lots of other things, Lockheed Martin produces it. And if you've ever seen a movie with major aircrafts with lots of fighter jets, it's very likely that Lockheed Martin was one of the ones that manufactured it because they are big players in that space. And so that's a company that I love. Next, we have JP Morgan. JP Morgan was a company when the pandemic hit, when it was $80, $90, $100 a share. It was just so undervalued. And I was loading up personally. It wasn't my largest position. I believe it was in my top 5 maybe back during this time of like mid 2020 when the pandemic hit, and I was loading up during that time, and the stock roared higher. And then I really started to ease up once we started to reach around the 150s or so, and so for about a year or so I didn't really do much with the stock. And now over the last year, looking at the year chart, it's currently down 25.93%, a year ago being about $150, and today it's worth $113. Now meanwhile, the company has continued to raise that dividend over the last several years, going from 56 cents up to today's dollar, so almost doubling in dividend payments, and it now has a solid dividend yield of 3.5%. Now, in my opinion, and I could go many reasons into this, but I think JP Morgan Chase is by far and away the most high quality bank of all the big banks out there. Better than JP Morgan, far better than something like Wells Fargo. And I think that the fact that you can buy a company of this quality, especially a bank of this quality, for such a low PE ratio and a high dividend yield, it is astounding that you can buy it at this price. People are worried about a recession, people are worried about inflation and high interest rates, and I think it's all noise, because at the end of the day, JP Morgan's going to be extremely profitable. They're very well capitalized, pretty much the best capitalized they've basically ever been. And meanwhile, the stock has went nowhere because people are worried about a recession. I think they're going to be just fine, and now is the time, in my opinion, that I think is a good time to be buying JP Morgan Chase stock. Do your own research, but once again, it's a company that I love, which is why it's massively high up there in one of the largest positions. In the last couple months, we added Vici to the portfolio. Now, when we added it, I believe it was around $28 a share, if I'm not mistaken. Now, since then, especially in a time during market downturn, it is shocking to see how well this company has performed, especially in the last 3 or so months that we've added it. It's really done well. This company, like I said, I think around 28 was when we started it just a couple months ago, and now it's at 34. A pretty solid return for that short time period of about, about 20% or so. Now, meanwhile, regardless of the share price, if you look at the dividend growth, it's been solid, and even in the last year, raising it almost 10%. And I believe we're due for another dividend raise on the next dividend payment. So yeah, in about a month from now, if they keep that streak, they will be raising it again. Hopefully they will. I think they will. But even with this big uproar in price of $34, you still have a dividend yield of plus 4%. That's not counting the potential raise that you'll be seeing. And when we were buying this company around $28 when I first added it, it was around a 5+% dividend yield. A 5% dividend yield in this market is astounding, when many other companies are yielding 1%, 2%. I believe the S&P 500 right now is in like the low ones, like 1.2, 1.3%. So a company that's well diversified, at least in terms of the Vegas casino properties, they basically own the Vegas Strip. So if you're bullish on gambling, if you're bullish on a lot of the basically just all the areas around the Vegas properties, like the Venetian and lots of things like that, then Vici is the one you want to own because they basically own Vegas. That's what Vici is. Now next we have Visa. Visa is by far and away the lowest yielding dividend stock in the portfolio, and they finally hit a bit of a downturn, and they've pretty much just been once again in no man's land for about the last 2-3 years for now. If you look, ever since about, let's see, where are we at here? January of 2020, right before the pandemic hit, this company has pretty much been nowhere in the last 2.5 years since the start of 2020. Now over halfway through 2022, it's about the same price, floated right around the $200 range. Now, this company has continually grown its revenue and profits every single year since the pandemic. Going over here to annual revenue charts for Visa, they have steadily been beating their all-time records, and even looking quarter over quarter, they are doing just fine. They are not worried about a recession. Ever since these peaks of late 2019, early 2020, they have crushed those, initially hitting a peak of about 6 billion, and now they're at 7 billion plus, and the same thing goes for their profitability. If you look at their free cash flow, they just put up record numbers. If you look at their net income, the last couple of quarters have been at or near record numbers, and they're doing just fine. And of course, knowing Visa as always, they've been buying back shares like crazy because this company buys back shares in a massive way and typically has a streak of raising that dividend, usually 10% plus year over year. Just looking at this right here, they raised it, I think it was like 17, 18%, whatever that number is, from 32 up to 38 cents. It's a low yielder, but it has fantastic growth on both top line and bottom line numbers, and that's why I'm bullish on Visa. And I think it's in a growing category, by the way, I might add, that I think is going to do great over the next couple of years. Now, Realty Income is another REIT. A lot of these higher portfolios right now have a lot of high REIT values in them because I want them being really defensive in a time when the portfolios are really getting hit hard during the market downturns. Now, this is going to slowly raise its dividend over time, very small amounts, and a lot of you know this company for being the monthly paying dividend company because most stocks pay out dividends either once a year or typically every quarter. That's the most common, every 90 days. Well, this company pays out dividend every month, so every 30 days you will get a check just as if you owned a property and you're receiving rent for it. Well, like WP Carey, it still hasn't recovered from its pre-pandemic high of about $85 or so, and right now it's trading at 72. A dividend yield still solid of about 4%, and like I said, raises that dividend consistently, at least once a quarter, usually multiple times a year. Normally they raise it anywhere from about 4 to 6 times a year, and with a solid dividend yield, steady income streams, and inflation raising rents, just like WP Carey, I think it's a solid buy. Next, we have Broadcom. For many years, all throughout the pandemic, all throughout 2020 and 2021, going into 2022, it was my largest position forever. I remember when I initially bought my shares in this company, I believe it was for $220. I got very lucky and was buying right down there, but most of the shares I acquired were around $250, $300 or so. And it's crazy to think that now this company is $500 plus. And just the other day, we actually almost reached $700. This company still has a solid dividend yield with dividend growth going from $1.02 5 years ago up to today's $4.10. That's over a 4x in dividend growth in a 5-year span. So massive growth as well as incredible share price appreciation, currently being up about 110% over the last 5 years or $277 a share. This company's been steadily growing its revenue, steadily growing its profits, and has a fantastic dividend yield, which is very defensive in this market. They've finally been starting to get hit a little bit from the downturns in the market, hitting that high of about 675 and today trading at about 545. So a pretty decent downturn, but it's one that I think will hold up well as we go through the chip shortage and more people need to buy tech products. Next, we have Pepsi. A lot of these core holdings, you'll notice as we get to the middle here, this middle part I kind of skim over through some of these because a lot of these businesses I don't really need to explain. You know exactly what dividends that Pepsi, you know exactly what type of business Pepsi brings. They sell snacks and beverages. They pretty much dominate the Walmart products in terms of chips and sodas and waters and basically anything that's a beverage or a snack. It's a good chance that Pepsi owns it. A decent dividend yield of about 2.5%, about as defensive as you can get. This company is just a cash flow machine like many other dividend core holdings you'll see in here, which we get into another one of the dividend favorites, which has had a great track record over the last several decades and is finally starting to hit a downturn here in the last couple of months with people worried about the housing market and the upcoming recession, or I guess I should say the official recession since it was declared just the other day. But Home Depot hit a high of about $415. Today it's $306, and it still has a decent dividend yield, but I think now is the time to be buying Home Depot. Don't be surprised if we end up owning this at a higher percentage than the targeted 5% right now, and we end up raising it to 6, 7, 8% if it keeps down or even goes lower, because right now it's trading at pretty solid prices. Speaking of companies that have been in no man's land, I mean, this is just like one of the most boring stock charts you'll ever see. It's up 1%, it's down 1%, it goes up a little bit, goes down a little bit, and it pretty much just goes nowhere. Luckily, the dividend has been steadily getting getting raised year after year after year, a very small amount from 5 years ago paying out 97 cents to today's $1.16. So about a, 20% raise or so over the last 5 years. Very slow growing, very boring company. It basically just sells toiletry products. I mean, if you buy paper towels or if you buy toilet paper or feminine care products, I mean, they pretty much sell all the basic household stuff that you need. Kimberly-Clark's a very boring company, very steadily company for bringing in profit. Next, we have 3M, another old school company, and it has really had a tough time in 2022. And I mean really. It is down 28%, and even in the last 2 years, throughout the pandemic boom, is still down over the last 2 years at negative 5%. At the last 5 years, it is still negative 31%, and it's pretty much been a slow downturn. This company has slowly grown that dividend. The last couple years have been stagnant ever since about the 2019 raise. It's went from $1.44 to $1.48. However, it's very defensive. It is a conglomerate that sells thousands of products, and basically as the economy grows, 3M is going to grow alongside it, and you will get a hefty dividend yield in the meantime. So as long as this company is able to eliminate debt, really refine its business for what it finds important, and it is spinning off that healthcare division, which we'll go over more one day, but it's spinning off its healthcare division mainly to avoid a lawsuit with some of its products, which once again, we'll go over that another day. But basically, I think it's a decent buy at these prices. I don't want to make it the largest holding in the portfolio, but a decent core holding, about 5%, is pretty steady. Next, we have Whirlpool, one that really surprised me because I didn't expect this company to keep downtrending, to be honest. The valuation behind Whirlpool is always weird. People always value it at an extremely low PE ratio, and it's such an odd business to value because on one hand, you look at a company like this and you won't ever really see major growth or any huge strides in profitability, but it kind of just slowly grows over time. If we go to WHR here and we plug in to find its revenue and profitability numbers, looking at the annual charts here, you can see what I'm saying. It's pretty stagnant. Ever since about 2015, 2016, it's pretty much went nowhere. Little higher, little lower, but the good news is its profitability has been on a bit of an uptrend, minus the 2018 negative amount here. We're not really sure what happened there, but other than that, its free cash flow and net income has pretty much been on an uptrend. Now that said, its dividend yield, dividend payout, as you can imagine, has followed suit from $1.10 up to today's $1.75 and pays a very hefty dividend yield of almost 4%. Not to mention, I would add that this dividend yield, even paying out almost 4%, this company still pays out, I believe its payout ratio is around 30% of its earnings. So it still has a lot to reinvest back into itself, to pay off debt, to grow its business, to do capital expenditures, or really lots of things. It has a lot of leverage, and it pretty much dominates all the markets, including things like stoves, dishwashers, washers, dryers, and anything of that sort. It pretty much benefits a lot from that category, especially when people are buying and building homes, such as myself. We just bought brand new Whirlpool washer and dryers that we love, by the way, and it cost us about $1,500, and they run like a charm, and it has all the bells and whistles, and we love it. So a lot of people like us buy Whirlpool products when they move into a new home or need to replace one of their big appliances. Next, we have one that's extremely controversial, which has really been downturned over the last 5 years and pretty much in the last year or two ever since the pandemic. Meanwhile, while the market's been roaring higher the last 2 years, this company's been flat at about 6%. Now, the last couple months, we did have a big of a downturn, but the one shining star of this company, they sell cigarettes, they sell tobacco products, which once again is controversial. But meanwhile, they've been growing that dividend pretty steady every year, and normally at about 5% a year or so. But there's one shining star behind this company. While you might be saying, hey, I don't want to own a cigarette company. Hey, I don't want to invest in tobacco products. There's one thing that stands out, and that is the astounding 8+% dividend yield. And I think this actually is a little bit off. I think right now it's actually a little over 8%, if I'm not mistaken. So this company has hit a massive gold mine in terms of the profitability of its cigarettes. The problem is people are not confident about the future of the cigarette business or tobacco business in general. Yeah, I did the math and I did 3.6, which is 90 cents times 4, and divide by the current share price of $44.23. M1 Finance is normally a teeny tiny bit off. Right now, its dividend yield is actually 8.14%. So 8+% dividend yield to invest in this company. Investors have gotten so pessimistic about the future of cigarettes and tobacco products and its big stake in Juul, and as well as some joint ventures with things like Kronos for the the smell good products. Yeah, we'll call it that. And this company, if you believe in anything future with tobacco or cigarettes, and this is the one for you. If you do not, then if you're willing to risk it for the biscuit of that 8% dividend yield, then this is the one for you. And if not, you should probably move on. The brand new holding, just added it maybe not even a month ago, maybe a month or so ago, right during this downturn. I believe we added it somewhere around the low here, probably around the price there is now at around 160, 150 or so. I'm not sure the exact price. But right around this downturn after its huge earnings miss, we added Target. Because normally this company has been yielding at around 1.5%, and now it is yielding 2% plus. This is a company that has finally hit a downturn after years of uproar. Finally, you get the chance to own Target at a 2% plus dividend yield, and it has been steady growing that dividend slowly until this year when you see the massive dividend increase of about 20-30%. Actually, yeah, that's about a 30% increase from 68 cents up to 90 cents. Not to mention, since they raise in August of every year, they're about to have a new dividend payment, and I'm actually curious to see what they raised it. Let me look it up. Okay, I'm glad I looked it up because I was curious. They actually raised it to $1.08, which is a 20% increase, which is a, let's see, 20. Actually, no, that's more than 20%. Let me see, 108 divided by 90. Oh, no, that's right at 20. My apologies. So if you take the new dividend, which is $1.08, multiply times 432, divide by today's price of $167.92, and now has a dividend yield of 2.57%. So not even 2%, 2.5%, which is getting pretty decent considering that's about double the average in the market right now, which I think long-term Target's going to be great. They've been hitting some short-term headwinds with the recession because a lot of people that are big spenders go buy at Target, but I think they're going to be just fine. Verizon has been very disappointing in share price as it's hit that massive debt load that it took out, and a lot of investors are worried, and this is one that's just kind of, it's hard to stomach holding it because it's so boring and the future looks a little dull, to be honest. But that dividend yield is solid, and so that provides some steady income to the portfolio. It also adds a lot of stability, takes a lot of the beta out because it doesn't really move a whole lot. It floats right around this $45 to $55 range, pretty much nonstop. It barely moves, so it adds some stability to the portfolio and brings in some solid income, but not super excited about the future of Verizon there. A lot of risk with it. Starbucks is one that has hit union issues, inflation issues, and just basically just a bad public image over the last year, but they've still been growing that dividend steady. They've still been going up reasonably in stock price, despite the last year or so being bad. They're still up 50% over the last 5 years. The last year has been pretty tough, down 31%. It's so shocking to see a market where stable, profitable dividend companies are going down 20, 30, 40, 50%. It is really shocking to see, and you can now buy Starbucks at a little over a 2% dividend yield. And I think that this company, while they have hit some hard times recently, I think they're going to get back to profitability. We keep on going back to Qualtrim here, and if I search Starbucks, SBUX, and I look at those annual charts, I mean, this is just a beautiful revenue chart. With their loyalty rewards, with their app system, my wife is a perfect example. If you take a company like this and you get the loyalty that they do behind their brand, behind their products, and the addiction that the that the coffee beans and caffeine cause, the people that come to the stores are going to keep on repeating over and over, coming back to this company. And that's why you have near record net income. And if you look over the last couple quarters, you see record after record. The last quarter putting in a record revenue number of $8.15 billion. Now, the profitability has been struggling right now with those concerns like inflation, like unionization, and as well as some odd closing of stores. But I think that long term, I think Starbucks is going to be just fine. And it's a pretty decent buy right now. That's why we have it as a small holding. NextEra Energy Partners, the one energy holding. This is basically just for diversification purposes and to take advantage of that massive increase quarter after quarter. NextEra Energy is a renewable energy company that has a decent dividend yield currently at about 3.5%. Next, we have Caterpillar Corporation. Caterpillar currently has a dividend yield of about 2.5% as well. It's finally started to come down in price. It started to get really high in valuation there at about, May of 2021. So about mid-2021, we reached at about $250 per share. But now over the last year or two, it's finally started to stagnate and come down in price, going back down below the 200s at 182 and coming back to a decent valuation, decent dividend yield. Caterpillar is a decent one to invest in times when we're in a recession because it gets to a really low valuation. Procter & Gamble, stability company, just like Pepsi or Kimberly-Clark. Basically, they're for stable dividends that are usually around 2 to 3% with decent growth and very defensive earnings. They're going to be just fine over the next 5 years as they grow with inflation and they continue to buy back shares and pay out dividends. Same thing for McDonald's, pretty much the same thing, another core holding. We've really lowered our target percentage as the dividend yield has went lower, the valuation has went higher, which goes along with the same story of Coca-Cola. I don't need to describe this business. Just like Pepsi, it basically sells a crap ton of beverages. If you know the drink product, there's a good chance that either Coca-Cola or Pepsi owns it. Currently 2.6% dividend yield, and that's the dividend growth portfolio. And then to go quickly over these 4 growth stocks that I own in order from largest to smallest, we have Amazon. Now I bought 200 shares of Amazon at an average price of $117.50, so I was buying right around, if I can find it on my mouse, right around here. So this company has really had a bad time in 2022. If you look over the last 6 months, or let's do year to date, they're down about 20%. Over the last year, about 20%. But over the last 5 years, well, the charts are all messed up because of the stock split, so ignore that. But basically, this company has done good long term, but they have had some trouble recently in 2022 with their profitability. But once again, going back to the charts here, if you look over time, this company is doing just fine, and I think they're going to get back to massive profitability. If you look at their net income charts year over year, it is astounding. Look at the growth of the profitability, and I think that will continue once we get past the ugliness of 2022, because if you look at 2022's profitability, not only are they not meeting records, they've turned negative. So I think now is the time, in my opinion, where I'm buying shares where people don't want to own them because they're not excited. So now's the time where I decided to load up on Amazon. And if you thought that Amazon's net income and profitability and revenue charts look good, look at this company called Salesforce, ticker symbol CRM. No. Let's look at the quarter over quarter. Look at this beautiful quarter over quarter revenue chart. Record after record after record after record. And if you look at this company's year over year, net income and profitability and free cash flow and all that good stuff, if you look at total free cash flow and nominal numbers, reaching multi-billion dollars now, if you look at free cash flow per share, which factors in dilutions of the shares outstanding growing, continual to grow every single year. The net income last year almost didn't reach it. They report their numbers a little bit odd, so I think free cash flow is personally the way to look into this company. But long story short, it's a beautiful subscription revenue business. They've been growing like crazy, growing like a weed, even up 100% plus despite this massive downturn. Year to date, down 27+%. I currently own 100 shares at $2.15 per share, so I am down on my investment. I'm down on 3 of my 4 investments, which takes us to the next one, which is iRobot, which valuation-wise, this is mostly a valuation play. I think they're a decent company. The one thing that sucks about this company is the massive just volatility in the earnings. I mean, it is all over the place. If you look year over year at the revenue, if you just look at the revenue, it looks very pretty. Year over year growth, year over year growth. If you look at the net income, it's pretty jagged. You have big upturns, you have big downturns, and now you're getting into 2022, which things are a bit unclear. And this company has its debt and it has its cash kind of do the same thing. Its EPS do the same thing. And if you look quarter over quarter, that's when things really get jagged. Free cash flows all over the place, net income's all over the place. But I think that this company's going to do fine as its valuation has reached just ridiculous lows. Look at the 5-year chart on iRobot. I think that this company is due for a bounce. There's no way, in my opinion, that I think that this company stays at around $50 per share. I think we eventually see the point where within the next year or two, we eventually get back to $100 plus, especially within the next 5 years, if that's possible. Next, we have Chewy. Chewy is my worst investment of all time, owning 300 shares at $67.86 a share. I believe that's the price, $67 and change, whatever it is. It has been awful. The year to date is 30.8%. 1 year is negative 51%. Negative 2 years, negative 22%. In the last 5 years, we have a little bitty green of plus 13%. We started to see recovery lately, with the last 3 months being up almost 35%. But that said, this company's doing terrible. They've had one little bright spot lately in the last quarter or so, where they put up their first real profitable quarter in the last year or so, and they're talking about finally flipping the margins. The revenue, the top line, has been doing great, reaching record after record, but the profitability has really struggled. You see, last quarter, they finally put up a small $18 million profit when they were expected to put up a big loss. They're expected to put up a big loss next quarter, so let's see if they come in with another big surprise. I hope they do, because this company has really struggled with margins, and that's the big reason why I've lost money on this company. I never expected these 3 quarters to be unprofitable, and not only unprofitable, but to be really unprofitable. I expected them to be very close to zero or even profitable around these numbers right here, and so that's why, with recession fears and slowing revenue growth, this has just been a failed investment. It's not one that I plan on holding. I've covered calls to sell this company at $40 a share, and I just take my losses and invest it into better companies. I currently am buying, like I said, like crazy, a lot more companies that I'm more confident in, like an Amazon, like a Salesforce, whatever, but it's one that I'm just not as confident as my other holdings. I think they will do fine long term. My covered calls expiration, I believe, are September 16th, if I can remember correctly. But if we have this company at that price, $40 a share or higher at the end of my expiration, I will be selling my shares. But if not, that's okay. I'll end up selling it probably around $40 or so. But that's it. That's all of them, guys. If you like this video, feel free to like and subscribe. Sign up to all the things down below. If you like this video, if you want to speak to me directly through a phone call or through email, you can do that. We have many people that follow me and talk to me about stocks and all that good stuff. And also, if you want to get signed up with M1 Finance, the brokerage that we showcased all day today, which is very easy and very simple to use. We've had 124 people signed up so far, and they all loved it. And if you want to invest in this portfolio yourself or copy it over or mess with it, this is a link to do that, as well as other things including Yada savings accounts, swag bucks, credit card referrals, and lots of other stuff like that. So thank you guys so much for watching. I appreciate all your help. I appreciate your support. Feel free to leave a comment down below and tell me how you think I did with this video. But other than that, guys, thank you so much for watching, and I'll catch you guys next time.